The trading floor is alive. It is September 2007, and Lehman Brothers is at the top of the world. The glass towers of 7th Avenue pulse with the energy of 15,000 employees moving through corridors that feel less like offices and less like temples, something between the two. The stock is trading above $82 a share. The firm has just reported its most profitable year in its 158-year history, net revenues of $19.3 billion, net income of $4.2 billion. Dick Fuld, the firm's chief executive and its identity made flesh, tells analysts that Lehman is on a roll. He is not performing confidence. He believes it. Then cut to September 15, 2008. The trading floor is silent, not quiet, silent. People are standing at their desks holding cardboard boxes. On television screens mounted above the Bloomberg terminals, a chyron reads, Lehman Brothers files for bankruptcy, the largest bankruptcy in American history, $639 billion in assets. Gone. The distance between those two moments is 12 months. What filled them is the real story. To understand how Lehman Brothers fell, you have to understand why it mattered that it existed at all. Henry Emanuel and Maya Lehman were German Jewish immigrants who arrived in Montgomery, Alabama in the 1840s. They opened a dry goods store. Cotton farmers paid their tabs not in cash. There was rarely enough cash, but in raw cotton. The Lehman Brothers began accepting cotton as currency, then trading it, then brokering it. They had identified a gap that the established financial world had not bothered to fill, credit and commerce for people operating outside the center of power. By the time the firm moved to New York after the Civil War and joined the New York Cotton Exchange, it had transformed from a general store into a merchant bank. Over the following century, it financed railroads, underwrote the initial public offerings of companies like Sears and Macy's, navigated the Great Depression without collapsing, and eventually evolved into one of Wall Street's premier investment banks. The firm survived 2 world wars, the 1987 crash, and the collapse of long-term capital management in 1998. That survival record was not incidental to Lehman's identity, it was the identity. The firm cultivated a mythology of resilience. It had been through the fire before. It had always come back. This belief, held sincerely by thousands of employees across every level of the organization, would become one of the most dangerous things about the company. The culture Fuld built when he took over as CEO in 1994 was a direct expression of that mythology. Lehman was the scrappy firm, not Goldman Sachs or Morgan Stanley. It had to fight harder, move faster, take risks the bigger houses would not. Fuld, a man who described the business as hand-to-hand combat, rewarded aggression, promoted those who brought in deals, and created an internal climate where caution carried a faint smell of weakness. The firm's compensation structure reinforced this. Traders and deal-makers were paid for performance, not risk-adjusted performance. The difference between those two things would take years to reveal itself. The turning point is not a single morning. It is a sequence of bets, each one defensible in isolation, that together assembled a machine of catastrophic fragility. Beginning around 2003 and accelerating through 2006, Lehman moved aggressively into the residential mortgage market. The logic was coherent, even elegant, as seen from inside the firm at the time. The U.S. housing market had appreciated consistently for decades. Mortgage-backed securities, packages of home loans sold to investors, offered attractive yields. And Lehman, unlike firms that simply underwrote and sold these securities, decided to retain significant holdings on its own balance sheet. This was, in the firm's language, having skin in the game. It signaled confidence. Between 2003 and 2006, Lehman acquired 5 mortgage originators, including BNC Mortgage and Aurora Loan Services. These were companies that generated the raw material, the actual home loans, that Lehman would then package and hold. By 2008, the firm held approximately $85 billion in mortgage-related assets. Its leverage ratio had climbed to roughly 30-1. That number requires a pause. At 30-1 leverage, Lehman had borrowed $30 for every dollar of its own capital. The mathematics of that position are unforgiving. If the value of the firm's assets declined by just over 3%, Lehman's equity would be entirely wiped out, not diminished, erased. In the conference rooms where these positions were assembled and reviewed, the argument for maintaining them was not irrational. It was built on historical data, and the historical data was clear. U.S. housing prices, on a national basis, had never declined significantly and simultaneously across all markets. The models said the risk was manageable. The models were trained on a world where the risk had never actually materialized. Those inside the firm who raised concerns, and there were some, faced a structural problem, raising an objection to a position that was generating enormous revenue in a culture that prized conviction and penalized hesitation, required more than analytical courage. It required the willingness to be wrong in public, in a firm where being wrong publicly was career-defining. The incentive structure did not punish the accumulation of risk. It punished the acknowledgement of it. The chain reaction, once triggered, moved faster than the firm could process it. The first tremors were visible as early as mid-2007. Delinquency rates on subprime mortgages began to rise. The housing price appreciation that had underpinned the entire structure of mortgage-backed security valuations stalled, then reversed. By the summer of 2007, two Bear Stearns hedge funds that had invested heavily in mortgage-backed securities had collapsed entirely. The market was sending a signal. Lehman's response in late 2007 and early 2008 was to manage appearances as much as risk. The firm began to selectively reduce some positions, but the reductions were insufficient relative to the scale of the exposure. More significantly, the firm engaged in a series of accounting transactions, later scrutinized by a bankruptcy examiner in exhaustive detail, that used repurchase agreements to temporarily move assets off the balance sheet at quarter end, making leverage levels appear lower than they were. These transactions, referred to internally as Repo 105, were not disclosed to investors in a manner that would have made their purpose apparent. Meanwhile, the firm's stock began to fall. In early 2008, Lehman's share price dropped more than 40% from its 2007 peak. The firm raised capital $6 billion in June 2008, but the raise, rather than restoring confidence, accelerated concern. It confirmed what the market suspected: Lehman needed money. Internally, the organization began to fracture in the ways that organizations fracture under existential pressure. Senior executives who had built their careers on the firm's rise found it difficult to accept analyses that implied the situation was unrecoverable. Fooled by multiple accounts, received assessments from subordinates that were filtered through layers of optimism, partly because his own conviction was so well known, and partly because the culture he had built made the delivery of bad news genuinely dangerous to the career of the person delivering it. The firm's president, Joseph Gregory, was replaced in June 2008. The chief financial officer, Erin Callan, was removed from her role in the same month. The personnel changes signaled urgency without addressing the underlying mathematical reality. Efforts to find a buyer or a capital infusion occupied the final weeks before the collapse. Conversations took place with Korean Development Bank, with Bank of America, with Barclays. Each fell apart for different reasons: valuation disagreements, regulatory complications, a fundamental uncertainty about the true value of the assets Lehman was offering. The U.S. Treasury and the Federal Reserve, which had facilitated the rescue of Bear Stearns in March 2008 by arranging its sale to J.P. Morgan Chase with government backing, declined to provide similar support for Lehman. The reasons given: that a private solution should be possible, that moral hazard concerns weighed against another rescue, have been debated by economists and policymakers in the years since. What is not debated is the outcome. On Friday, September 12, 2008, Lehman Brothers executives gathered at the Federal Reserve Bank of New York alongside Treasury Secretary Henry Paulson and the chief executives of the major Wall Street firms. The meeting was meant to produce a solution. By Sunday evening, it had not. Bank of America had pivoted to acquire Merrill Lynch instead. Barclays' potential acquisition was blocked by British regulators. Sunday night, September 14, became the last night. In the firm's offices, lawyers worked through the hours before midnight preparing documents that most had spent the previous weeks hoping would never be necessary. The bankruptcy filing was prepared not because anyone wanted to file it, but because, by then, there was nothing else to file. When markets opened in Asia on Monday morning, the news was already running on every terminal in the world. Lehman Brothers Holdings, Inc. had filed for Chapter 11 bankruptcy protection. The filing listed $613 billion in debt. Within hours, the human consequence was visible in photographs that circulated globally. Employees standing outside 745 7th Avenue in Midtown Manhattan, carrying the cardboard boxes that had been distributed on Sunday. Personal items, framed photographs, years of accumulated desk artifacts, carried out in containers that cost less than $1. In London, in Tokyo, in Hong Kong, across the firm's global offices, the same scene repeated. More than 25,000 employees lost their jobs in the weeks that followed. Retirement accounts built on Lehman stock were wiped out. Counterparties around the world who had assumed Lehman would be there the next day discovered they had been wrong. The bankruptcy's reverberations contributed to a seizure of global credit markets that required extraordinary intervention by governments and central banks across multiple continents to contain. The lesson that Lehman Brothers offers is not that leverage is dangerous, though it is. It is not that housing prices can fall, though they can. Those facts were knowable before the collapse. They were known, and they did not prevent it. The deeper failure is structural and psychological, and it persists in organizations long after the specific circumstances have changed. Lehman built a culture in which the generation of revenue and the assessment of risk were performed by different people with different incentives operating in different organizational realities. The traders who assembled the mortgage positions were rewarded when the positions made money. The risk managers who were supposed to evaluate those positions operated with less authority, less status, and less institutional weight. When the two came into conflict, the outcome was determined not by analysis, but by organizational gravity. More subtly, the firm's historical success had generated a form of institutional immunity to bad news. Every time Lehman had previously faced a crisis, the oil shocks of the 1970s, the 1998 near collapse, the aftermath of September 11, 2001, it had survived. That survival record created a cognitive template. We have been through worse than this, and we have come through. This template was not applied cautiously. It was applied reflexively, and it caused the firm to systematically underweight evidence that the current situation was genuinely different. This trap is not unique to financial firms. Any organization that has survived long enough to develop a mythology of resilience is at risk of it. The mythology is usually earned. That is what makes it dangerous, because earned mythology does not announce itself as a bias, it presents as institutional wisdom. And institutional wisdom is very difficult to challenge, especially from inside. What remains of Lehman Brothers exists in fragments. The investment management division was acquired by Neuberger Berman, which operates today as an independent firm. The North American investment banking and capital markets businesses were acquired by Barclays. The European and Asian operations went to Nomura. The brand itself, the name that took 158 years to build, is owned by no one in particular, a trademark attached to a legal entity engaged in the long, technical business of winding down. There is no Lehman Brothers. What there is instead is a case study taught in business schools, a chapter in financial history, and a question that has not fully been answered. If the firm's leaders had been told in 2006 exactly what would happen, exactly how the next 2 years would unfold, would they have believed it? The evidence suggests they might not have. And that, more than the leverage ratio or the mortgage exposure or the accounting transactions, is what makes the story of Lehman Brothers worth understanding. The instruments of its destruction were assembled in plain sight by intelligent people in a culture that had made itself nearly incapable of seeing them clearly. The fall of Lehman Brothers was not a failure of information. It was a failure of the systems that human beings build inside organizations to protect themselves from what they do not want to know.